Welcome back to the Escape the Clock video series, an information series where I, the author of the Escape the Clock book, walks you through how to build your program to financial freedom and early retirement. Hey everyone. In today's episode, we're going to talk about something that you might have assumed we'd have covered in detail by now, but we had a lot of important fundamentals that we had to get through. Now that that's done, we're going to get into how to accelerate our plan towards wealth, which is investing. Even if investing is new to you, no worries. I'm going to cover all the fundamentals. I'll introduce you to it. I think you'll be delighted to see there's lots of ways to invest. It's not just about the stock market. If you've been investing before or you've been doing it, and even if you've been successful at it, great. I'm also going to touch strategies, though, to make sure that we're being smart with how we're investing, because how we invest needs to change depending on where we are in our lives. When we're early and we're working, the way we invest can be a little bit more aggressive. We can take a little more risk. But when we get into a retirement situation, we need to be way more cautious. It's about protecting the wealth, but we can still take a little bit of risk here and there, as long as we're not going overboard, because the goal is to grow the wealth. It's not just about 4%, 10% withdrawals every year until it's gone. Again, that's not my philosophy. Mine is continuously grow your wealth throughout your life so that you have something left over at the end to pass on to loved ones or your favorite charity, something to leave behind, part of the legacy of what we're looking to do here. So there's a lot of great stuff we can cover, because remember, investing is that accelerant. It's the gas for the fire. We're going to go in and start learning everything we need to know about it. And before you know it, you'll be able to start seeing your money grow, and you'll know that you're accelerating towards financial independence. So let's get into it. It may be no surprise, but the big questions for today is, how does investing work? How do we do it safely? But also, how do we make money from our investments? It's not just about selling them, even though that's a huge part of it. There are other ways we can actually profit from holding investment in something. We'll cover a couple of those options today. What is investing? Well, the formal definition is the allocation of capital, which is your saved money, with the goal of generating returns on that over time. So really, it's a simple way of saying it's putting your money into something with the hope it gains value so you can get more money back out of it. This is about buying and trading, and that's why the stock market is so commonly used. Different markets can allow you to buy different shares of something, and then if it gains value, you can profit by selling those shares to someone else. Stocks are a great example because there are so many publicly traded companies across the world that it's actually pretty easy to buy shares into many, many different things. And those companies can increase or decrease in value. And so you have different options of what you can do based on how that goes. There's also crypto. It's another digital option that isn't company based that could allow you to benefit. And you can even use a lot of standard brokers to make crypto trades now, such as through iShares and things like that. I'll cover crypto in more detail in another video. But it's not just limited to companies. You can also trade in the real estate market. As we mentioned before, that your own home is a real estate investment. Your property itself that the home is built on, any structural improvements you make in the home, this can increase its value, which means others might be willing to pay more than what you paid in order to attain your home. And as you get more equity in the home, and if you could sell it for more than what you bought it, that's actually not a bad investment. Other physical goods can do the same. You can actually invest in gold, silver, cattle, energy. You can even invest in storage units. There's many different ways to invest your money. It's not just about company-based investing. For the real estate side, if that's something that's interesting to you, you can invest in other homes that you don't live in. And instead of actually trying to manage all those homes yourself, you can pay for a property management company. If you do that successfully, then all of the rental money that comes through becomes passive income directly into your pocket. So as you can see, these investments can actually generate passive income for you depending on how you do it. The last and maybe most important investment, though, is investments in yourself. Anything that you're doing to invest in learning or in your mind can really help your mental well-being and your ability to be successful in some of these areas. You can invest in your body or your health, which I would argue in early retirement is part of that. Having more time to do healthy activities is fantastic. Investing in social relationships can also be good for your mind and your health as well. Investing in your retirement is something you're actually doing right now, listening to me prattle on. This is all about being mindful of how do you get there and different ways to do so. Also, that you're able to think about a retirement means you're working, and that means you have skills. Those skills can actually generate money for you because that investment can create royalties. If you're a graphic artist and you make graphic designs, you can actually sell those and act like a freelancer in a retirement situation and collect those royalties. Or maybe you love music and you could learn to start putting music out with one of the many platforms. That's more royalties as well. There's many, many, many options of this. And it doesn't just have to be your existing skills. You can use your early retirement situation to build new skills and try to create royalties out of that as well. Why is investing so lucrative? Well, it's because we can have compounding returns over a period of time. If you take a look at this graph here, it's just a simple example, but it shows that over a 20-year period, if you were to make $1,000 contributions, you'd have a completely linear line after the end of the 20 years if you were just keeping that cash. You'd basically end up having $20,000, sitting on the shelf. Now, if you put that into like a 5% fixed CD, you'd have some other percentage coming back, and therefore that investment would be higher than that slanted line. You'd have a different line. If it was a variable rate of return, such as with like a high yield savings account, you might even see a bit of a curve there. But what we're really talking about is really chasing those really good rates of investment and being willing to leave them to sit over a longer period of time. Because the truth is, it's not going to be some smooth curve. It's going to be very spiky up and down because markets will change daily. And as these markets are changing, someday you'll see it going up, some days you'll see it going down. But if you zoom out over time and smooth that out, if the market's healthy and the investment's good, you'll actually see that it is a much larger curve than it would be any other way. And that's what we're looking to do here, making regular contributions over time and letting them sit and bake until we can get it to a point where we made a lot more money than we would have otherwise. So to do that, we need to be smart, though, in how we invest. Take a look at those two graphics there. I mentioned that things will be spiky. They'll go up, they'll go down. Here you can see on the left, a big dip. It's scary. You see a dip. You go, oh no, my investment's bad. I need to sell this thing off. But again, if you zoom out and you look in the long term, that dip might have been painful, but it might have just been a temporary dip over some issue that's happening in the market. And overall, the investment can always recover. It can always end up high. Now, that's not me saying never sell your investments. Sometimes things are bad and you need to sell, but sometimes people can be a little emotional to these throws and sell prematurely and end up in a situation where you're actually just causing a lot of churn and you're creating frustration. And then if you want to buy back in, you're buying back at a higher price. You're really eating into your gains. So for the most part, it's about being willing to try to not be emotional, put your investments in and be willing to invest often and really wait it out. And also talking to advisors. Some advisors will maybe advise you to sell out. Great. Okay. Why? Compare that to what you're reading, what you're seeing. Don't just do things because the market is down. Do things because you've done your research. Eventually, you'll sell it and you sell it on your terms. You'll sell it because it's the right time to sell the investment, either because that's the other investments are still growing and that one is served its purpose. So stay patient, slow bake them, and also think about cost. Each investment has a cost to it. You can find lower cost index funds and ETFs, which are much easier to manage, aren't costing you more. That's not to say that you shouldn't be willing to pay more for a good investment. Definitely not saying that. But if it comes to a new person investing, definitely start simple. Start with those low cost, low risk ETFs. And then as you learn how it works, be willing to diversify to other types of investments. How do you even go about picking stocks? Take a look at that matrix on the left. Depending on how much effort and cost you're willing to put in, it can really vary how you're going to do it. If you just look, I don't want to do a lot here. I know you're telling me I have to invest. I'll do it, but I don't want it to be hard. I don't want it to be expensive. Awesome. Robo-advisors are the way to go for you. They're easy to set up. You tell them how much risk you're okay with. They set up alerts, and there you go. You're in the game. If you're willing to put a little bit more effort in, though, you can just go with index funds. These are a diversified set of stocks. You can buy into one. There's some examples here on the slide. And then you're in there. You have to set up a brokerage account, though. To do that, go to the Escape the Clock website, the resources page, and I have a list of brokerage services there. And then you can go ahead and start looking into them. Pick ones that you like the way they charge, you like the features they offer. If you're okay with higher costs, but you don't want to put the work in, that's where financial advisors come in. You're paying them to manage your portfolio. Some of them can be very good at this. Some will make big promises, but they'll struggle to deliver. My advice is, whoever you sign up with, understand how they're getting paid. Are they getting paid by transaction? Are they getting paid by a percentage of your wealth? Ask them for a legal disclosure. Look at it before you sign anything. And if they're going to promise they can beat the market, they better be able to beat the market. You can beat the market. If a financial advisor is not beating the market, And the financial advisor is taking massively large risks, or they're making trades that are a little suspicious. Like, why did they pick things like that? Well, what agenda do they have? So, anyways, make sure that you can look at fiduciaries, and you can schedule time with me if you'd like to talk more about selecting a good financial advisor. Last one is if you're willing to put the effort in, you're okay with the cost, individual stock selection, building a custom portfolio. The effort comes from the research. You have to research all the different types of stocks, and some might be more expensive than others, which gets me into the other side here. Number two, how do you choose your stocks? I break them into the four different categories here. First, there are growth stocks. These are companies that are really profitable. They continuously grow. In the past decade, this has been pretty much all tech stocks. That's why you see things like Amazon, Tesla, and Nvidia making a lot of money, and the stocks are very expensive. They make it in the news a lot because of that. But it may not be tech in the next 10, 20 years. We don't really know. It changes based on where we are. These companies can be really lucrative. This can be the aggressive strategy where you're trying to build your portfolio more quickly. So you're making bets into the stocks that are going to grow the most, but it can be a gamble. None of these are guaranteed to always be profitable. Which takes me to the next one, which is value stocks. These are companies that aren't going to have the massive growth every quarter, but they're reliable and they can be more affordable. Instead of $100 a share, you might be looking at just tens or $20s a share. So they're not out of the game. They've been doing it for a while. These are things like, JP Morgan, like a really established bank, or Procter & Gamble, who you are likely buying products from every day. So they can be really good ones in your portfolio. And they often offer dividends, meaning that when they're profitable and they're reliably profitable, you're actually getting a share of those profits on their calendar schedule. So something like a Johnson & Johnson or Walgreens, as they're making money, you're making money. This is great. So having value stocks with dividends, it can be a really reliable source of income in your retirement situation. Growth stocks can also offer dividends, like a Google or Microsoft, they do. But again, they're growth stocks, so it may not always be quite as reliable as some of the value stocks are when it comes to those payouts. Last is index stocks. Maybe you don't want to have to individually select. That's where an index fund comes in. It's a collection of stocks, and it can be across lots of different sectors and types. SPY, Spider, is a good example of this. VTI, VTO, or other ones too. They're not too expensive. They're ETFs, so they're managed for you, and they have been very reliable, but they don't typically beat the market. The reason ETFs don't typically beat the market is because it's a big collection of stuff. Some of those companies will be up a day and others will be down, and the net result is usually under what the market is for any other given stock. So, but they can be a very great way to get started, especially if you don't want to go and research a bunch of different stocks. Today's project is all about making sure that your investments are set up. Even if you've already been doing investing, you might want to consider another route. If you've been doing stock market investing, maybe this is the time you might want to think about real estate or cryptocurrency, for example. Whatever it is, it's worth creating an investment plan. Sit down, think through what your investments to look like, and also figure out what your risk tolerance should be for that type of investment. You can go through different tools online and questionnaires to kind of suss out what your different risk tolerance is for a given area. You can also review that plan with a financial advisor, making great conversations to try to hone in on how much risk you're okay with and learning new things about doing investments in that area. Then you need to start researching the basics about it. Look up tutorials online, try to understand. For commodity trading, what does it look like? What should I expect? What are the lessons learned? And before you know it, you finished your first milestone, you actually have a full investment strategy. Then you need to make sure you're able to do the investments. That means researching brokerage services, robo-advisors, or financial advisors. And so make sure you pick a platform that supports the features, but also the cost that you're willing to take. You might need a specific feature depending on your strategy. So look into it ahead of time and make sure you understand how the advisor or the broker gets paid. You can use the Escape the Clock resources page to see a list of these. And once you get started, make sure that you look for any promotions when you go to create your account, especially if you're consolidating money in. If you're moving money into a brokerage service, sometimes there's promotions for bringing enough in, which means you're making money just by creating the account. Once you have your platform enabled, then it's about building that wealth. Start small, especially for a new area that you've never invested in before. Think about doing something like $50 or so. Complete a trade, monitor it for a week. Whatever you learn, you can update in your investment strategy plan. Then you can start to build confidence and do automatic investments. Consider a dollar cost averaging strategy where you're actually contributing your amounts over time instead of all at once. So instead of $1,000 all at once, you might do $250, $250, $250, $250. This means that when the markets are up and down, you're averaging it out and you're managing some of that risk. Over time, though, you want to make sure your automatic contributions build up to the amounts that you're comfortable with. Maybe it's $100 out of a paycheck to start with, but eventually you might want to get up to 1,000 or so, or whatever it is, to help you towards your goal, especially as you get comfortable with the investing. Creating a calendar reminder, you can remember to go check the investments on a regular schedule instead of fussing over them daily and potentially having an emotional reaction. And before you know it, you'll have completed your third milestone, which is that you have contributions in action, you're making regular dollar cost average based investments, and you're really starting to build that wealth. Stock selection, investing, this is something that you really need to do if you want to make it to a point of financial independence. If you think you can make enough money from work to have a good retirement, that's great. You probably are finding different strategies to maximize 401ks. You're able to find, maybe you're using a backdoor Roth to get your IRA to a good place. If you want enough money to quit work early, you need to do that outside of a retirement account. The retirement account you can't tap early without penalty, and the exceptions just aren't lucrative enough to be able to get access to that money when you need it. So you need to be able to take the money you're making from work and make it into more. And I'm not talking about having 3 jobs. Having an extra income source is great, but more because of the same reason. It's because then you have 2 sources of cash to funnel into your investments. The investments can be scary, right? It can feel like a gamble. But if you do it smartly and you're doing it carefully and not emotionally, then I think you'll be surprised that it actually isn't that hard. Put enough cash in, be willing to maybe even ignore it. Just sit and let it wait continuously, even like automatically set up rules that put cash in, and just let that snowball build. Because for an early retirement situation, we're talking about at least a 10-year horizon, right? It's probably 10 to 30 years before you can have enough wealth built up to last you for the rest of your life. It's great. 10 years, 20 years, 30 years, that's the amount of time we're talking about having that money in the market for that snowball to become the avalanche that you need it to be. So review some of the things we talked about here: robo-advisors, financial advisors, ETF selection, all of the good stuff. It's all here to help you get going. Later, I'll cover even more ways of cashing in those investments, such as how to option stocks, how to do a glide path, how to diversify in different ways. And before you know it, that portfolio that you built will be lucrative, will build confidence for you that you can safely quit work. See you then. Quick reminder, I'm a retired program manager, not a financial planner or a fiduciary. All the information presented here and in the Escape the Clock book is expected to be reviewed with a certified professional. Thank you for tuning in to today's episode. Support the show by visiting escapetheclock.com, where you can find the guide, the planner, and more episodes. If you need help with building or running your program, you can schedule help at the site. If you, a friend, or loved one is feeling trapped by work or money, let them know about escapetheclock.com. Remember, time is your most valuable asset. Start living life on your terms and escape the clock.